is Brian Murray, partner and COO at Craft. We're doing another session on operating during a downturn today. There's been a lot of questions across the portfolio about what's going on in the macro environment, what we expect to happen in the next few quarters, and most importantly, what you all can do about it. So this is a part 3. We had our first session in February when the downturn was first kicking in. We caught up again in May. This is about 7 months later, checking in again. So if you go to the next slide, we'll just go over a quick agenda. Like I said, I think it's important to look back on what's happened so far in 2022. A lot has happened, so let's talk about how we got there. We'll share some thoughts on what to expect in 2023. There is no crystal ball, but there's a lot of ways to think about scenarios and a lot of early indicators that we should all be paying attention to. So we'll go through those. And then, like I said, the most important part of the session today are the actions that you as founders can take to put your companies in the best position possible. So with that, I'll hand it over to David to start us off with a recap of 22.
Okay, thanks, Brian. So I think, as you guys know, the big story of 2022 was this huge correction in the public markets for not just SaaS stocks, but pretty much any growth stocks. At the beginning of the year, or really November was the peak. That's when the Fed started raising interest rates. They finally got off the line that inflation was transitory, and they started raising rates to combat inflation. So November of last year was sort of the peak. And since then, it's been pretty much just down in terms of valuation multiples for SaaS and other high growth companies. So as an example, the median SaaS company at the peak last year was valued at around 13.4 times next 12 months revenue. And today that number is 5.3 times. So it's been a 60% drop in valuation levels. And then the median SaaS company grows about 20% year over year, or it was. For high growth SaaS, which starts at 40% growers and above, they peaked at an even a higher level, around 31 times next 12 months revenue. And now they're trading at about 9 times. So it's been a 71% drop in public market valuations for SaaS companies. And Jeff will cover marketplaces as well. There've been similar drops in marketplaces as well.
Yeah, we've seen very, very similar declines in the prices of the publicly traded marketplace companies.
We're starting to get data now on private valuations. Cooley just put out some data on how valuations have changed since Q1 versus Q3. And what we saw is that rounds that we're getting, the average was getting done at around 58 million valuation in Q1. That's come down to 45. That's a 22% drop. Series B has dropped from 164 to 90. That's a 45% drop. Series C from 500 to 130, which is 74%. Series D has dropped all the way from 3.5 billion to 527 million. That's an 85% drop. Now, these numbers are not apples to apples. Like, these are not the same companies that raised in Q1 that then raised in Q3. So there is some variability in there, but I think there were over 1,000 data points. So this shows the trajectory is that as the public markets have corrected, the rounds that are right before the public markets, basically the public markets, the exit for these late stage growth rounds, they've necessarily had to correct, and it's gradually trickled all the way down. So, I think it'd be good for everyone just to kind of internalize how much valuations have changed, especially for later rounds. And what this has done is it's raised the bar for proof, because if you want to get, say, a unicorn round done now, it's probably not going to be a Series D round. It's going to be a Series E round, and it's going to require that much more ARR, and we'll get into that. In addition to valuations coming down, there's just a lot less activity right now. Capital availability has dried up. And again, this is from the Cooley data. It's just showing that less capital is being deployed right now. Now, part of this is because founders don't necessarily want to raise right now. Valuations are not great. And so there's a lot of founders who are kind of holding out. Eventually, I'm not sure that that's necessarily a great strategy, because I think that eventually everyone's going to have to raise sometime next year. we're not expecting valuation levels to improve much. So I wouldn't necessarily expect this chart to look a lot better going into next year. Although if it does, if more capital is deployed, there may be even more companies seeking it. So regardless, we're seeing a capital crunch. And again, I would expect this to continue into next year. So that's basically what's been happening I'd say, like for the first 3 quarters of the year. What we didn't see in the first quarter or even second quarter of the year that we are now seeing in Q3 is a dramatic slowdown. So the first few charts were really about what's happening on Wall Street. Now we're talking about Main Street. We're talking about real world economic activity. Salesforce just reported Q3. And I'm not picking on Salesforce, amazing company. They're kind of the bellwether for the whole software category. And their net new ARR in Q3 dropped from 1.1 billion from Q2 to 360 million in Q3. So huge 2/3 drop in net new ARR. And what that did is, because they were spending the same amount of money on sales and marketing, roughly $3.4 billion in the quarter, but because they were now doing 2/3 less net new ARR, it exploded their CAC payback. So their CAC payback grew from what would normally be, call it 3 years, to something like over 12 years, 155 months of gross margin adjusted CAC payback. So there are a lot of implications to that, right? So I don't think any company, even Salesforce, can make their unit economics work if it takes roughly 13 years to pay back the acquisition cost of a customer. So the implication of this is they're going to have to cut sales and marketing spend in the coming quarters. It's just not sustainable. And if Salesforce is cutting sales and marketing, then imagine the effect on every other company, because if they're going to cut their marketing costs, that means they're paying less to the companies they advertise with, they're spending less on events, or if they cut sales, it means they're cutting headcount. And that means that you think about like all the other companies that Salesforce is buying software from, there's just going to be a lot fewer seats to be buying from. So again, very unpredictable macro environment. I think this is starting to feed on itself. As companies encounter this slowdown, they're going to be cutting costs and cutting seats, and then that feeds into the next reduction in demand for all of their vendors. And we're, again, starting to see, this is data from, I think, Goldman Sachs, showing the net new ARR on a quarter-over-quarter basis. You can see that for public SaaS companies in Q3, it wasn't just Salesforce. The entire cohort of public SaaS companies on the whole, as a group, saw net new ARR drop 13% over the previous quarter. This is the first decline in quarter-over-quarter net new ARR since that COVID swoon period we had in Q2 of 2020, when the market basically crashed in relation to COVID and lockdowns. And I think you could probably go many years back and not see a decline. So this is really the beginning of a SaaS recession, if you want to define that term, based on net new ARR going negative in terms of change over previous quarter. And Q4 is looking even worse. This is looking like a 47% reduction, which is just massive. So again, demand seems to be drying up for even public SaaS companies. And I would not expect the situation to be that different for privates. You're seeing this now in terms of the forecasts that these public SaaS companies are putting out to the street. Their last 12 months, this is actually the top 10 SaaS companies by multiple, by expected value to next 12 months revenue. So these are considered, you could say, the best SaaS companies in terms of growth and the market's expectation for, or how highly valued they are relative to their revenue. So these are the companies, these are SaaS companies the market thinks most highly of. Their last 12 months revenue growth was 62% collectively, and they're projecting forward only 32% for the next 12 months. So you can see that their expectation is that growth will slow by roughly 50%. And we're seeing something similar on marketplace companies. Jeff, you want to take this?
Sure, yeah. So yeah, basically the same story here. This is 10 of the most highly valued marketplace companies based on their enterprise value to next 12 months revenue multiple. And you can see that, the average of these 10 in the last 12 months was 38% growth over the year prior. And what analysts are expecting over the next 12 months is only 13% growth. So a drop of 65% in terms of growth rates. So, pretty similar story and a dramatic drop in growth.
Yeah, and just to go back for a second, if you look at the expected value to next 12 months revenue, just pay attention to those multiples. I mean, they are, they're pretty low. And similarly for the best SaaS companies here, what you're seeing is 10 to 15 times next 12 months revenue. These are companies that are at scale. They've got $1 billion plus of ARR. They were still growing last year at 60+%, next year at 30%. They're de-risked, they're category leaders, and they're on average only able to command an 11 times multiple. So just keep that in mind as you think about like valuations in the private sphere. Last year we were seeing private SaaS rounds get done at 100 times ARR roughly, which is literally 10 times what these companies are trading at. And those are private companies that might be growing faster, but are not nearly as de-risked as these companies. So it's a little bit of a wake-up call as well on valuation levels. Okay, but I think the main point here is that every indicator that we're seeing is showing a huge slowdown in demand. So it's not, again, when we talked to you guys in May, the story was all about capital markets seizing up and just preparing for a regime change of lower valuations and capital being much harder to raise. Now what we're telling you is expect demand to dry up, or at least to be greatly reduced, because we're heading into essentially a recessionary economy. Hard to say exactly how big a recession is going to be for the entire economy, but I think we can say pretty confidently that for software companies, the recession's already here. So what to expect for next year? I think number one, you should expect reduced demand for new business. Like we talked about, if the best public SaaS companies are forecasting a 50% reduction, you can no longer assume that what you did last year is a benchmark for what you're going to do over the next year. I think maybe a better baseline assumption would be 50% reduction in the demand level you saw last year. Number two, we're going to see elevated logo churn. There's going to be a lot of companies that run out of money and die over the next 18 months. Again, everyone's been holding on, not trying to fundraise because, again, the environment's bad. Everyone understands that. But frankly, there's a lot of companies that just don't have the metrics to raise. And as they run out of cash, they're going to die. So expect to see increased logo churn. And I would even go so far as to say that the logo churn we're going to see, it's one of the reasons it's going to be high is that there's what I would call deferred startup mortality in the ecosystem, because it was so easy to raise during the boom years. Everything was up and to the right. A lot of companies raise money that maybe shouldn't have raised money, or maybe I think maybe a more neutral way of saying it would be that they don't have the metrics today. They don't meet the bar today for financing. And as they run out of money, they're not going to be able to raise more. So expect a lot more logo churn. How much logo churn could there be? Historically, in the SMB space, you've seen maybe 15% logo churn in a given year. I think that number could grow to 30% pretty easily. Certainly, if your client base consists of a lot of startups. The third thing you're going to see is seat contraction. So even if a company doesn't churn, they don't go out of business, you don't lose them on a logo level, you're still going to see them buy fewer seats. And the reason for this is just headcount freezes and layoffs. So we're just seeing now layoffs across the board. And so companies, they're sharpening their pencils. They're just not going to need to buy as many seats. They're going to start consolidating the number of vendors that they use. And when they do buy, they're just going to try and be more parsimonious. So, I think one of the scary factors here is that for the last decade or so, seat expansion has been a huge tailwind for SaaS companies. Just every year, a good SaaS company could count on starting the year at roughly 120% of last year's ARR just from existing customers. And that was based purely on seat expansion. But now I think the baseline could actually be seat contraction. because just like all of you guys are sharpening your pencils and cutting seats or not growing as fast, I think you're going to see your customers do that as well. So between elevated logo churn and seat contraction, I think we could see a phenomenon where instead of being at 120% net dollar retention next year, we could be at 80 to 90% net dollar retention. It could be the case that last year's existing customer revenue could shrink this year for the first time in over a decade. You could also see longer sales cycle for those of you in enterprise sales. At least your customers are not going out of business, but it could take longer to get approvals. And just the overall environment could get more ferocious. You could see customers trying to demand discounts. Again, procurements is going to be a lot tougher next year. And I think it's just, you're going to see more price pressure. So I want to just like translate all of these factors into what a typical SaaS startup might see and how they might misforecast their year. And I'm going to take the example, just to keep the numbers round, I'm going to take the example of a SaaS startup that has 10 million of ARR, but do whatever mental adjustment in your head that you need to in order to make it relate to you. But let's take a startup that has 10 million of ARR, and what it's planning for next year is to grow 2x, so from 10 to 20 million of ARR based on net dollar retention of 120%, which they've seen historically, which would mean that their existing customers go from 10 to 12, and then they're projecting new business of 8 million to get them to 20. And they're planning to burn 20 million next year, which would be a burn multiple of 2. So they've looked at, our burn multiple article, and they're thinking, well, look, if we can add 10 million of net new ARR, then we can justify spending 20 million. That's burn multiple of 2. And let's say they've got 40 million in the bank. So they feel really good that, okay, we've got at least 2 years cash. We can hit this number and they'll be able to fundraise, at the beginning of 2024. Well, what actually could happen? Well, like we talked about, public SaaS companies are saying new business demand is 50% less than expected. So they could very easily end the year only adding 4 million of new business. And then net dollar retention, like I mentioned, could come in at 80% rather than 120%, which means that they actually shrink from 10 million of ARR based on existing customers to only 8 million. That could actually happen. And the result would be, if those things happen, this is just a scenario, but I think it's a very likely scenario for an average SaaS company, that ARR only grows from 10 million to 12 million, which is to say 20% growth. So you could have a shortfall in which you expected to grow 100%, but because new business is less than you thought, and churn and seat contraction is higher than you thought, you end up only growing 20%. That means that the burn increases to 26 million based purely on revenue shortfall. And that will explode your burn multiple from 2 to 13. So in other words, your net new ARR was only 2 and you spent 26 million to achieve that. So that's a burn multiple of 13. And if you look at what that would do to a typical runway, and we modeled this out, your runway at the end of the year, you thought you had at least 12 months of runway. You will now only have 6 months of runway. That's a company that's in crisis. That's a company that is not going to be able to raise more money because it is not capital efficient. Its burn multiple is beyond the pale. It's not really growing. And they've just spent the vast majority of their war chest raised under totally different conditions. This is a company that again has 6 months to live and is in crisis and will probably be doing a mass layoff. And that still may not be enough and may well be going into wind down mode in 3 months and filing Chapter 11 in 6 months. So that is how fast things can change. This is a company that started the year with 10 million of ARR, had every reason to believe it would grow to 20. After all, it grew 2.5 to 3x last year. It had 40 million in the bank. It was really confident about its prospects. And a year from now is, in crisis and looking at basically filing bankruptcy in 18 months. So that is how quickly things can change in this environment. And the reason I'm giving you this scenario is because, nobody thinks it can happen to them. I just want you to be aware of what could happen. And so you plan for next year, you create, again, I would focus on creating a conservative scenario, but we're going to come back in a minute and talk about what you can do about this. Let me kick it over to Jeff to do the marketplace side of this.
Okay, thanks. So kind of a similar story on the marketplace side. We sort of broke this out between B2B marketplaces. Those are marketplaces where the demand side is made up of businesses or B2C marketplaces where the demand side is made up of consumers. Going through the B2B side first, you probably have a sales team selling into businesses to recruit them to use your marketplace. We think those sales cycles will get extended and will become longer over the next 12 months if they haven't already started to get longer. We think you're going to have lower close rates on those deals. You may get companies to talk to you, but the rates at which you convince them to experiment with your marketplace, we think will be lower, and therefore your close rates will be lower. All of this will lead to less new business, less experimentation. Companies, small businesses, medium-sized businesses, enterprises are doing a lot less experimentation when they're trying to tighten their belts. So because of that, you will see less new business. And you'll see more churn from the demand side of your marketplace, where either businesses are really having to rationalize their use of your marketplace, and maybe it doesn't have the return that they that sort of meets their threshold, and so they will churn. Or, as David alluded to earlier, you will have more fatality in businesses. Certainly, if you sell in, if the demand side of your marketplace is made up of smaller businesses, you will see more fatality among that cohort. On the B2C side, we think there's going to be less predictability in your return on advertising spend and your CAC. I say less predictability because it actually could go either way. In some ways, things could get better on the advertising side if there are less competitors spending advertising dollars to compete with you. You may see some advantages from that and increase your your sort of effectiveness of that ad spend. On the flip side, when you have consumers that are themselves tightening their belts or have lost their job and are not spending as much money, as I say here in the second row, your conversion rates go down. They're not willing to buy your product or buy your service, and so your CAC can go up as well. So there's just less predictability there in your ad spend and your CAC. Consumers we expect to be more constrained over the next 12 months. Some consumers will lose their jobs. Some consumers will just be more mindful of their spend. And when consumers are constrained, they spend less, again, driving slower growth for B2C marketplaces. And then just less repeat usage in your marketplace. If you cater to consumers, they may still use your marketplace occasionally, but less frequently than they have in the past, as they look to try to save money and tighten their own belts. Okay, let's go to the next slide. So this is an example of a marketplace, kind of similar type example as David just went through for a SaaS business. As I've shared a blog post on burn multiple a few months ago, I think going back earlier this year. And it's important for marketplaces to look really at your annualized gross profit dollars, because there's a lot more variability in gross margins for marketplaces relative to SaaS businesses. SaaS businesses tend to have 70 to 85% gross margins. Marketplaces are kind of a little bit more all over the map, from as low as 40 or 45 up to 80%. So we try to normalize for this by looking at gross profit dollars. So that's what we've done here. The 2022 actual column, this is a business that did $10 million of gross profit in 2022. They had $25 million of expenses, so they burned 15. That was a 3x growth year over 2021. So they went from like 3.3 million of gross profit to 10 million of gross profit. They ended 22 with 20 million of cash. That means they have approximately 16 months of runway at the end of 22. And their marketplace burn multiple, based on the methodology I described in the blog post, is 2.3x, which is not bad. They expect, their plan in the next column for 23, they expect to go from 20 million of gross profit from 10 million of gross profit to 20 million. So a 2x year. They just want to increase their OpEx marginally from 25 to 30. So they think they're being relatively conservative by not increasing their OpEx too much. So their plan is to lose 10, which is actually less than the 15 they burned in the previous year. This would be a 2x growth year, with ending the year at 10 million of cash. Runway at the end of the year of about 12 months at the end of 23, which puts them to, based on their plan, that gives them enough cash to have cash 2 years from now until the end of 24. And that's a 1x marketplace burn multiple if they hit those numbers, which is really good. But in reality, because of some of the dynamics I described on the previous slide, they only go from 10 million of gross profit to 13 million. They miss their $20 million number. They only get it to 13 million. They still spend that 30 million that they were planning on, which means they lose 17 million instead of 10 million. So their burn actually goes up from 15 to 17 instead of down from 15 to 10. That means their growth was only a 1.3x growth year. Their end of year cash, they end the year with 3 million of cash at the end of 23, a year from now. That means they only have 2 months of cash, a marketplace burn multiple of 5.7, which is not good. And again, they're sort of a company in crisis at that point because they only have 2 months of cash. And that's a huge problem, particularly with this growth rate, where it's going to be very difficult to attract any type of venture capital if you only grew 30%. Next slide.
So yeah, just to close out on that, it's possible, that if you're trending towards these numbers, you're going to want to react sooner than waiting the entire year, but it's probably going to take you 2 quarters to figure out that things are badly off track. And then it's going to take you another quarter to implement whatever you're going to implement. So, maybe you'll have 1 quarter of extra cash, from whatever change you implement, whatever cut, but that's not going to change your situation that much. The bottom line is these companies went in, both the example that Jeff is mentioning and the one that I did, with assumptions that were too aggressive and they were burning too much money. And they went in thinking that like a burn multiple of 2 was fine, but it wasn't. All right, let's keep going. All right, so what can you do about this? So number one, obviously, if you have the opportunity to top up your war chest with cash, certainly we'd all recommend doing that. I don't know that this is actually feasible for most companies right now, but if you can, I would also tell people, just don't get anchored on old valuations. They're completely meaningless now. Like, quite frankly, like the market was set by Tiger last year and they're not even in the business anymore. Again, the rule of thumb last year was 100 times ARR. It might be 10 to 20 times now. So just get out of your head, whatever valuation was achieved last year. It can't do anything except, distort the picture for you. Number 2, forecast conservatively. And here, I think the key is don't assume that don't count on revenue that doesn't exist yet. So what I see in a lot of forecasts is that runway is calculated based on including future revenue, future ARR that doesn't exist yet, and it's used to offset future burn. The problem is that burn is something that you can count on because you can plan for it, whereas future revenue is not. And so the way I've always calculated a runway is simply to divide your cash in the bank right now by your most current month's monthly burn. That's it. That's the number of months of runway that you have. And finance people will get you in trouble because they'll start doing some fancy forecast. So again, I can calculate your burn in like 2 seconds. They will create like an Excel model to tell you what your runway is. And again, that depends on assumptions. And in a highly volatile macro environment, those assumptions have a way of not coming true. And furthermore, they always surprise the downside. No one gets surprised the upside. So again, I would have a really good grasp on what your runway is. Let's call this simple runway. This cash in bank divided by current month's burn. Sometimes I'll talk to a founder. One of the first things I'll ask is, what's your runway? They can't tell me. And then they're like, I got to talk to my finance person. No, just calculate it this way. You don't need to talk to your finance person. You really need to know this. It needs to be on the tip of your tongue. All right. Number 3, based on the simple runway I talked about, you need to adjust your OpEx to have at least 24 months of runway. That's what's going to take to get you through this recessionary period. I think it needs to be a burn multiple. I would even encourage you to have a burn multiple of 1 moving forward. Why? Because if you start at 2 and then you encounter downside surprises, that number is going to be 4, 5, 10. It's going to grow enormously. So I think you want to be going into the year with an incredibly efficient burn multiple so that if there are downside surprises, you have a cushion. 2 doesn't really, if you actually ended the year at 2, that would be okay for most companies. But if you go into the year at 2, you have no cushion for downside surprises. So again, ideally, your burn multiple going into this year is 1, which means that the amount of net new ARR you're forecasting equals the amount of burn that you're forecasting for the year. If you go into the year thinking you're going to burn twice your net new ARR, it's going to be really painful if your net new ARR falls short. It doesn't all have to be negative here. Use this recession to your advantage. Retool your business now to operate on a super efficient basis. Your hands are untied. What I mean by that is nobody cares anymore if you do layoffs. Like no one's going to write that. The press a couple of years ago would write a hit piece about any startup that had to do a layoff. You weren't the hot company anymore. Employees wouldn't want to work there. You're afraid of all those types of considerations about perception. It doesn't matter anymore. I think like Elon has kind of reset things completely. He went in, cut 3/4 of the employees from Twitter. He showed really how much agency you have as a founder. You can go in and make those types of changes. And the way that companies are being valued now in the public markets, they're being valued now on not just revenue and growth, but cash flows. So there's a number of software companies that actually have really strong ARR. They have pretty decent growth, but they're phenomenally inefficient. And they're being punished by the market. And quite frankly, those companies are going to end up being owned by private equity shops. And what those private equity firms are going to do is they're going to go in there and make the changes and the cuts that the founders were too squeamish to make. And there's a bunch of private equity firms that are going to make a lot of money over the next few years because founders didn't want to make the necessary changes. And that's a shame because those founders worked for a decade to create these companies. And then a bunch of private equity sharks are going to make all the profit. So don't let that happen to you. Don't let the private equity firms, even if your company is successful, don't let them make all the money. Retool your business now to be super efficient. There's been a regime change. It's not just about revenue anymore. It's about margins and efficiency. And this is the best year ever to make those changes because nobody, they're not going to take any kind of hit. And by the way, your employees have nowhere else to go. I mean, hiring is like pretty much dried up. So this is the time to retool your business to be super efficient. And then once you've cut the fat, expect overperformance. Don't let the recession be an excuse for your sales team not to deliver, for the rest of the company not to deliver. It doesn't make sense to have sales capacity that you don't need, that there's not enough pipeline for. So cut the bottom performance, but then expect overperformance from the top performance. After all, you're going to be feeding them. Their lead flow might double. So you can basically hold people to a higher standard, cut the non-performers or the low performers, but then hold everyone else to a higher standard. Again, look at what Elon has done at Twitter. He's basically said, listen, if you don't want to be hardcore, if you don't want to return to the office, if you don't want to work hard like a startup needs to, then take the severance package. So just because we're going into a recession doesn't mean that you have to have low expectations. In fact, you can have super high expectations because everyone's got to go into crisis mode. I mean, everyone's got to be really hardcore or you're not going to make it through this recession. So cut down to that hardcore contingent. Use this. You have the opportunity to build the company that hopefully you've always wanted to build. And, you can rethink all of this like fat and entitlement that somehow got layered on during this like artificial boom period. So as a founder, you can finally do whatever you want to do. Your hands are untied. Just think through that. I think consider returning to the office. Maybe it's not feasible to have everyone in one central headquarters, but I would at least try and cluster your team in hubs. There is simply no evidence that remote work is productive on a company level. In my experience, I think that developers have always been remote and field sales has always been remote. Again, people out, sales reps in the field doing enterprise sales. But the reason for those two teams being remote is that their performance is very easy to measure. Developers, you can just look at their code commits. How much code are they checking in? By the way, Elon did that at Twitter. He actually looked at who is checking in code here. And he found out that 60% of the engineering team wasn't checking in code. Just look at the repo. That's why the RIF was so big. No point having engineers who don't check in code. But my point is having remote engineers, if you're looking at their code commits, easily measurable, field sales reps, they bring in their sales attainment, very easy to measure. For everybody else in the company, where their performance is a lot harder to measure, there is no proof that remote makes anyone more productive. And yet every company went remote. I think it's time to reconsider that. At least 4 days a week, bring people back to the office, make them work. Try to cluster people into a few hubs instead of having them all over the place. You're going to be doing a RIF anyway. So you're going to be rethinking your whole employee base. You can now like rationalize it. You can make it more sensible. And then finally, act fast. You know, there's that Sequoia slide where, you know, companies always leave this too late. The sooner you make whatever rationalization you're going to make, the better, because you'll have all that extra cash and you'll start operating on this new, more efficient basis. Whereas the company that waits too long, it makes one cut, it's too small, comes back, makes another cut, too small, but then the savings they get is just not big enough. And then before you know it, you're in like wind down mode. So now is the time to act. I mean, really, the time to act was 6 months ago when we did the last one of these, but now is really the last time to act. 6 months ago, there wasn't a demand contraction. It was just about valuation multiples. Now it's both. We have a reduction in capital availability. We also have a reduction in demand. So this is the time to be super efficient. And again, you know, you look at what Elon did at Twitter. This is not like a political statement at all, just in terms of thinking about him as an operator. You don't have to like agree with him about speech or whatever else, but just think about him as an operator. He went into Twitter and the question he asked is this person excellent or are they absolutely critical to the business? And if somebody couldn't justify one of those two things, then they were part of the RIF. So think about that. Who on your team is really excellent? Who is really critical? You know, there's a lot of non-critical roles. And frankly, every company has people that they probably wouldn't hire today. They're not so bad that they get fired, but you wouldn't necessarily hire them today knowing everything you know now. We're in an environment now where you can't afford that anymore. So, and you have you have the degrees of freedom. Founders have a lot more agency than they think. You have the agency. You're not hamstrung. The one thing you have total control over is your burn and what your cost structure is going to look like. You don't have control over what logo churn is going to be completely next year. You don't have control over demand next year because a lot of that depends on the economy, but you do have control over your burn. Orlando Bravo from Toma Bravo had a good tweet about this. He said, software companies tend to panic when there's a slowdown. It should be okay as long as you accept the fact there will be a lower level of business for some time and you adjust your resources accordingly. Look, there's a recession every decade. You can't just build your company to only, you know, survive during the fat years. You have to be able to survive during the lean years. It's okay. Things are going to slow down. Like I had a tweet, 2X is the new 3X. Last year, VCs were expecting you to grow 3X. Now I think VCs understand how hard it is and would be very happy with a 2X. But I think the larger point is, think of yourself as a plane flying into intense headwinds. If you try to maintain your speed, or if you try to maintain an arbitrary speed that you think you need to get to, you will burn a ton of fuel. It's very inefficient. So maybe the better course is to optimize for fuel consumption. It's okay to slow down. Maybe it is only a 20% or 50% growth year, but you conserve your resources so that when we come out of this recession in 18 months, you're still alive. So prioritize survival, prioritize efficiency. Do not think in terms of we have to grow at some absolute rate. Think about your efficiency metrics. Think about CAC payback. Think about burn multiple. What you should do is only spend money on efficient growth. If you can't grow efficiently, if you can't do a CAC payback of say 12 months, if your CAC payback is 3 years, just forego that growth for now. The growth will come back in about 18 months. So don't waste fuel. It's really important. Prioritize survival. And, you know, I think part of what we're doing here is giving you permission to grow more slowly, because I think VCs are always saying, rah, 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 grow faster, faster, faster. No, grow efficiently for now. And one person I want to introduce here is Mike Robinson, who's a new partner at Craft. He was most recently at Georgian, which is a late stage fund, and he's come on board at Craft as the lead partner on our growth fund. And I'm really excited that Mike's joined the team, and he has deep operating experience in FP&A. He has been a VP of finance before. And he actually, we got to know Mike on one of our portfolio companies where we worked very closely together. And Mike actually went in for 6 months and was the interim VP of finance because they didn't have one. And we were really impressed with Mike's expertise in that area and also with him as an investor. So we think this is a really amazing upgrade to the Craft team. And Mike is here for all of you in terms of FP&A and planning. And let me kick it over to him on this.
Thanks, David. So the theme of this conversation has been efficiency. And next week on Wednesday, we're going to do a deep dive on all things related to that. As David mentioned, I have been dropped into different companies to help with exactly this problem. So next Wednesday, we're going to be talking about the playbooks and all the lessons I've learned to get to efficiency. Specifically, we'll cover 8 things you can do. And then secondly, we'll dive into all the budgeting tools that will help make it much faster and more efficient to do so. In terms of attendees, ideally, it's the CEO founder and the head of finance if you have that, but it's not required. So that's that, and really looking forward to it. Over to you, Brian, for questions.
Cool. All right, Michael, great to have you on the team. It's been awesome working with you already, making an impact across the portfolio. And thank you, David and Jeff, for going through everything. So we had a bunch of questions that came in by email before today's chat. If you have questions, go ahead and drop them into the chat. But let me start with this. The question is, how are investors thinking about all the dry powder in funds that has yet to be deployed? How long can investors reasonably hold out without deploying capital?
Yeah, I mean, so I think at Craft, we feel really good about the amount of dry powder we had. We'll be announcing soon that we raised Venture Fund 4 and Growth Fund 2, about 1.3 billion total. So we have that dry powder that you're talking about, but what I can tell you is we're extremely patient. Our job is to, we don't feel any pressure to deploy. That would not be doing anyone any good. So that's not our job, is to just kind of deploy capital on a schedule. We'll deploy capital into opportunities that, that meet our bar. And, these funds actually, they're 10-year funds, but we actually have 5-year investing periods if we need them. So I don't think we'll take 5 years to deploy this fund, but it could be 3 years. And given that the most VC funds were deploying over one year to 18 months previously, like last year, we were seeing that pace of deployment. If every fund kind of has that attitude of going from 1 year to 3 years as an expectation, that's a 2/3 reduction in capital availability. Combined with the fact that I think a lot of I think that's going to be much harder to raise venture funds moving forward. I think LPs are reassessing how much capital needs to go into the space in light of public market valuations. So, obviously Craft is in a really strong position. I think there'll be a shakeout among the lesser VC firms. So I would not have this attitude like, oh, VCs have to fund us.
And the only thing I would add to that is I think investors will be, valuation sensitive, and they'll be looking at the public markets to, as a cue to valuations as well. So I think investors will be investing next year, and they'll be investing in the companies that sort of follow the advice that we've suggested here, that, that cut their costs, that aren't burning so much capital relative to their growth, and maybe maybe they do grow a little bit slower, but they're companies that are sort of accepting that and adjusting their resources accordingly.
Yeah, that's a good segue to the next question, Jeff. If I am to grow modestly but efficiently next year, let's say 2x with a burn multiple between 1 and 2, am I fundraise eligible?
I mean, I think the answer to that is yes. I mean, obviously there are a lot of specifics that matter about the company and the competitive landscape and all the other things that investors look at, and the team. I think if you're growing 2x next year, that's actually pretty good. And if you're doing it efficiently and your burn multiples, 2 or lower, I think that's also that's also pretty good. So yeah, I do think you would be investable.
Yeah, I think I would just add one thing to that, which is it's stage dependent as well. So if you're growing from say 1 million of ARR to 2 million of ARR, that's not that impressive. But if you grew 5 million of ARR to 10 million of ARR next year, with a burn multiple of say 1, which is to say extremely efficient growth, I think that would be investable. I think we would look really seriously at that. And that's why I tweeted 2x is the new 3x. Like before, we might have wanted you to show growth from say 5 to 12.5, or 5 to 15 with maybe a burn multiple of like 3 or whatever would have been fine. But now I think it's more about if you could do a burn multiple, you could do 2x with a burn multiple of 1. I think that'd be pretty impressive. And certainly, if you could do that at 10 million of ARR or up, I mean, anything above 5 million, I think like a 2x with great efficiency would be impressive next year.
Okay. Next question is, from a founder's perspective, how long can we expect this recession to last? And I'm going to combo that with another question, which was, what are early indicators that things are getting better? What should we keep an eye out for?
So on the recession, so let me just give you a data point on this. So Goldman Sachs is actually forecasting 0.3% GDP growth next year, which is not a recession. I personally think they're wrong. It won't require them to be wrong by much for there to be officially a recession next year. But regardless of whether the number is like -1% or -0.5% or 0.1% or whatever, there's a recession in software, right? Like, it's not like, if the economy shrinks by 1% next year, it's not like every industry shrinks by 1%. That pain is spread very unequally. And what we're seeing right now is there's a tremendous amount of pain in software because, again, just the buyers are getting, they're scrutinizing their expenses much more closely. They're buying fewer seats, they're buying fewer vendors, they're consolidating. And again, the startup customers, which do consist of a big part of the ecosystem, they're also now, that market's going to dry up to some degree. So regardless of what happens in the overall economy, and I think it's all looking really grim right now, you should expect that this software recession will continue. In terms of when we can expect to get out of it, Goldman thinks the next 2 quarters are going to be very negative, and then the second half of next year will be positive. Other people I talk to think it's going to take 18 months to get out. So, hard to say, but I think my assumption would be that we come out that I think the base case would be the Fed cuts rates in Q4 next year. That's and then that percolates through the economy and we start getting out of the recession in the middle of 2024. So I think 18 months is a reasonable assumption.
All right, some tactical questions. So I'm going to combine these two. One is, any tactical advice on pricing? Should we lower our pricing to increase the likelihood of closing, or increase our pricing to give us a better shot at hitting targets? I don't know if you can comment on that. And then related, have you seen any SaaS companies lean into PLG bottom up or change their go-to-market strategy to adapt to this new environment?
Yeah, so I don't know that there's like a clear takeaway for pricing based on current economic conditions. I mean, it depends on how much competition you face in your market and how much demand you're seeing and what the market can bear. It could be the case that you should raise prices because your product is underpriced and your unit economics don't work unless your price is higher. So that's one question. On the other hand, there might be companies that are in spaces that it's very competitive and they have to, if they're going to win deals, they're going to have to give discounts. So I don't think there's one answer on that question. In terms of go-to-market, what I would say is that if you can lean into PLG, it's a good thing, because I think one of the things I'm seeing is that the idea that every deal needs to be touched by a sales rep is being questioned. So I think there was this view before that PLG was, PLG has always been great for top of funnel. And then the question is, could you get it to self-convert, or does it need to be touched by a sales rep? And the answer is different at different companies. What I would say is that if your PLG does need the assist by sales, then do it. But if you can operate with self-service, try to run those leads through self-service first. Don't have them touched by a salesperson, and then just have the leads that need to be touched by a salesperson do that. So in other words, like, your sales operation can be much more efficient. That's one of the conversations we had recently in one of our portfolio companies. And I think what happened, and that's the way they always operated, was they were self-service first, but then they hired a bunch of salespeople and they were ending up comping a lot of salespeople on deals that would have converted self-service anyway. So now they're rethinking that. So I would just say, like, rethink how to get efficient about everything.
Yeah, and just to add to that, it's not just the quantity of salespeople, but also all the ancillary functions that emerged in the last few years. Sales engineering, sales enablement, management, training, all these other things. That's something that we've seen in a lot of companies that is worth questioning.
Totally. So, one of our portfolio companies, what we saw was that quota attainment at the team level was great. I think they're still hitting like 90% quota attainment. And their quotas and commissions were reasonable. And yet their CAC payback was enormous. And we're like, wait a second, this doesn't add up. If your sales team is performing and attaining, why is your CAC payback so bad? And the reason is they had a zillion non-quota carrying heads in sales. And so, like, there's all these overhead roles that have blown up in the last few years. This is what you got to get really efficient about. So Larry Ellison has a great quote, which is, if you're not building the product or selling the product, you're overhead. And that is where you need to get like super lean. I think, if you have great coders, the 10X engineers who are building your product, they're obviously keepers. You have great AEs who are hitting their numbers. They're definitely keepers. Everybody else, you can like reevaluate, quite frankly.
Okay, we got a few more. One is when investors do become more active again, do you think that will show up first in certain sectors or stages?
Well, there's always a hot sector du jour in tech, over the last few years, it was crypto and Web 3.0, whatever that was. That doesn't mean investors are right. I mean, now like the hot thing is AI, but when the market comes back, I don't think it's going to be like sector specific. There'll be some, there'll always be some new hotness that VCs are obsessed with. But by and large, I just think that the market will come back when the economy comes back and interest rates return to a more normal level. But one thing to keep in mind is that when the market comes back, it's not going to go back to what it was in 2021. I think you just have to understand that was a bubble. So, maybe like what the bond markets are saying right now is that 10 years from now, interest rates are not going to be at 5% like they are now. They're going to be at like 3%. So we can expect interest rates to start going back down maybe in a year, but so you're going to see like some multiple expansion once interest rates are lower, but it's never going back to 30 times. Maybe it goes from like 9 times to 12 times or something like that. So like things are just never going to be as frothy as 2021. So do not be like, if your mentality is we're going to hold out until like the bubble comes back, I don't think there's going to be another bubble.
The only other thing I would say is I think one of the things that will happen first is actually the public stock market coming back, which I think will be, which will be before the economy really recovers, because the stock market tries to be a leading indicator on what's going to happen with the economy. So probably what you'll see is, the beginnings of a rally in the stock market, maybe next year at some point, kind of before, while the economy is still potentially in a recession. And then it'll be kind of predicting, that the economy will be coming out of a recession. And I think once venture investors start to see the public markets recovering, I think that will also open up the floodgates a little bit more on the venture side.
Yeah, I think that's a great point, is that venture investors, VCs took their cues from the public markets on the way down, and they'll take their cues on the way up. What the public markets are concerned about, it's very simple. Like the weighing machine is, earnings and multiples, and which is a function of interest rates, and interest rates are a function of inflation. So what the market is looking for is comfort that inflation has been tamed, and interest rates will come back down to a more normal level. And then they also want to know that the softness that they're seeing in the economy, that companies like can still hit their new revised forecasts. It's not worse than expected. So I think like when we finally get comfort around those two things, you could start to see a market rally and things pick back up. But probably it's going to take a few quarters of results to like know that we're like out of the woods if we are.
Okay, last question. Profitability. What are your thoughts on startups seeking profitability rather than, we talk about having a appropriate burn multiple, but should they try to not burn anything at all, or is that going too far?
I think it depends what stage you're at. I think if you're at, 50 to 100 million of ARR or the equivalent for a marketplace business, I think you could start to ask that question. And maybe you should ask that question if you're not growing. Like if you're not growing, what is the point of burning all this money? The point of burn and the dilution that comes with it is to achieve exceptional growth. So you can dominate a market, take market share, and then eventually you'll be able to like mint money with that franchise. But if you're not able to grow and yet you're at some decent scale, you might be more of like a private equity play. And you might want to just bring your burn down to zero. Now, if you're a super early stage company, I'm not sure how realistic it is to set the goal of profitability. That would be, but certainly if you can, but I would just say that, just being super efficient is the goal, not necessarily profitability. Jeff, do you have anything to add to that?
No, I mean, look, there are some companies in our portfolio that are in that 50 to 100 million or plus range. And, and I think like you said, if you're not growing super fast, if you're growing at, 30% a year or less, you should get to profitability, and you probably can get to profitability if you have that much revenue. In the same way that we've seen Elon do significant layoffs and Twitter still exists, I think, there's opportunity to, to cut fat in those companies and to get to profitability. And I think it's a great thing to strive for.
Yeah. Imagine if you're a $100 million a year revenue company, and let's say you're growing 20%. So that's not particularly attractive to VCs because it's not growing that fast. But if that company is profitable or just not burning money, then it doesn't need to raise again. You control your own destiny. There's no more dilution. And you can ultimately grow your way into, you could get to 200 million and then IPO. So there could be an exit for that company. But that same $100 million company growing 20% that's burning a lot of money, no one's going to touch that. The public markets just aren't interested in that kind of company anymore. So what the public markets seem to be saying is we want capital efficiency. We don't want to see these huge burn numbers anymore. We want to see companies that are profitable. So yeah, I think there are some companies in our portfolio that should start thinking that way. It's like, how do we get to profitability? Because profitability, again, at 100 million, like that would be pretty impressive. And I think you could drive to a pretty decent outcome.
Well, and you control your destiny. You control your own destiny. You don't have to rely on anybody else. You can make different investments at that point in time. You can take some bets, and some of them may pay off and accelerate your growth rate. And you're in a totally different place when you don't rely on venture investors or any investors to come in and sort of save you for the next round.
Right. You can have profitable growth. Just because you're profitable doesn't mean you can't grow. Obviously, what you do is you take those profits and plow them back into growth. So it's a more constrained growth model because you're not willing to like deficit fund your growth, but you can still grow. And every successful company eventually gets to that point. Like this whole idea that like companies can be money losing, that's not the way it's supposed to work. Every successful public company eventually makes money. It's profitable. And that's what they're judged on. So the question is not whether you need to become profitable, it's just when. And if your growth has stalled out, then that may be the time. There's no longer a reason to be going into deficit spending and taking dilution if it's not buying you anything.
Cool. All right, well, we're at time. So thank you to all the founders who joined the session. It is recorded. We will be sharing it out after the session. Also, make sure to catch Michael's session next week on Wednesday at 8 a.m. It's going to be way more tactical, extremely useful. We'll send out some more details about that. Thanks, David and Jeff, and thank you, everyone, and happy holidays. See you soon.
Thanks, everyone.
Thank you.